I'm Michael Fox, and this is the Prospector News Podcast. And I am joined by the founder and CEO of the CPM Group, Jeff Christian. Happy New Year, Jeff.
Happy New Year. Best wishes for 2024, Mike.
Thanks, and same to you. We're looking towards an interesting year, and we'll get into that. But before we get into today's discussion, let's give everybody an overview of what the CPM Group is for those who aren't familiar with you.
Okay, well, CPM Group is a commodities research company. We do basic fundamental research on precious metals and other commodities, and we provide that as a consulting company to any person or group that has a large financial exposure to precious metals or commodities. We do a lot of fundamental research. We produce annual yearbooks with statistics on gold, silver, and platinum group metals, which are considered by people in the core of those markets to be the Bibles for those markets. We've been doing this research since the 1970s, longer than anybody else. We have connections around the world to gather data on what are very secretive markets and opaque markets. And because we came out of J.R. and Goldman Sachs, we understand how commodities are traded and hypothecated and used in financial markets a lot better than people who are desk analysts. Our clients pay us to be right. They don't pay us to be bullish. They don't pay us to be bearish. They want to know where we think the markets are going and why. And that's what we do. And we do it through research. We do it through consulting.
Wonderful. As I like to do at the end of the year and the start of a new year, it's always kind of good to reflect back on the past year when I've made decisions, what were good decisions, bad decisions, what surprised me, those types of things, and then I look forward to the next year and try and adjust my thinking accordingly. So let's take ourselves in the Wayback Machine to January of 2023. When you were looking at the year, what was it that you were seeing in 2023? What did you get right? What surprised you? What came off as being different than what you saw it?
Yeah, it's interesting. Let's start with the metals prices first. We thought that gold prices would rise sharply to a new record level. We underestimated how much it would rise. We thought that platinum and palladium and rhodium prices would fall. We underestimated how much platinum and palladium and rhodium would fall. We got platinum, I think, pretty well right. And then we thought silver would move sideways, and it did. Now the reasons why we thought that was that we didn't think there would be a recession in 2023. We have been saying for some time we put a likelihood of a recession most likely in 2024 or 2025. So a year ago, we were saying there shouldn't be a recession in 2023. We thought that the Fed would raise interest rates through the first half of the year and then plateau, but not lower interest rates. We thought that the dollar would not collapse, but would remain relatively strong, if not rise a little bit more. We thought that inflation would continue to decline at a moderate pace, and we expected fiscal policy in the U.S. government to be stalemated and problematic. So I think we got the macroeconomic and political environment right. We just sort of underestimated how much gold would rise by and how much platinum, palladium, and rhodium would fall by.
Yeah. Now, with the gold price, if I were going to be, saying one of the things that surprised me last year was how quickly the Fed shifted from a hawkish to a dovish position in their last statement in December, and that caused the gold to jump. Did you see that kind of a change in the Fed talk coming, or did that catch you by surprise as well?
We expected the Fed to say what it said. What we didn't expect, and we're still trying to process, is you've had in 2023, you had this disconnect between what the Fed was saying and doing and what the markets expected the Fed to do. And, the Fed and other central banks have been very accurate and explicit in saying, this is what we're going to do. And the Fed was saying through 2023, we expect to raise interest rates in the first half of the year. We're going to continue to assess where the market and the economy is. We may, we're probably getting close to a peak, but we don't necessarily see interest rates falling in 2023. And the market kept saying, oh, the Fed's going to stop raising interest rates and it's going to lower interest rates. And the Fed did not lower interest rates last year. And then by the end of the year, you had monetary, the market, the Fed was, as you said, the Fed was very explicit and more explicit than we thought. We thought the Fed was likely to lower interest rates twice in 2024. They came out and said, we'll most likely lower interest rates in the second half of 2024. And the possibility is a 25 basis point reductions over the course of 2024. The market went from saying, oh, we expect 3 or more interest rate cuts in 2024 to saying, oh, we expect 6. And then the market was disappointed, because the Fed saying, no, 6 is outrageous. We don't see interest rates falling 1.5% next year. We see interest rates declining 75 basis points or half as much as you think. So the market's now pivoted away from, 6 interest rate cuts to 5 interest rate cuts, but they're still out of line with what the Fed and other central banks around the world are saying. And so I think that the markets are setting themselves up to be further disappointed over the next several months.
I see. Yeah, it's strange the way the markets react to the Fed often. I find that they overreact regardless if it's, what they perceive it to be bad. They overreact on the bad side and they overreact on the positive side, and instead of just listening to what's actually been said. But
I think there are a couple things. One is that, and you have to say, what's the market? I think big banks and brokerage houses and others think that they can maybe pressure the Fed to do what they want, which is lower interest rates, by not reacting, but pre-acting, by saying, oh, we think the Fed is going to do this. They might be able to force the Fed's hand. And they don't, and they can't. But the other thing is that there's other parts of the market. There's the, more investor side, institutional and retail investors. And these people, there are many investors who think that the Fed looks at the stock market and says, oh, we have to raise or lower rates because of what the stock market's doing. The Fed is chartered to look at unemployment and employment and inflation, and to look at the economy. And if you look at what the Fed has done over the last 110 years, the Fed has focused on the economy and its charter. We're looking to maximize employment and to keep inflation under control. The Fed does not look at the stock market and say, oh, we need to raise or lower interest rates because we're supporting the stock market. But there is this belief that that's what the Fed does. And as long as you believe something that's not true, your projections and expectations are going to be disappointed. It's just the reality of reality.
yeah, it's the old adage, garbage in, garbage out, isn't it? So in 2023, apart from the conflict that broke out in the Middle East, which was clearly a black swan event and nobody saw coming, what events happened that were a surprise to you and caused you to maybe rethink your positions as we go forward in 24?
I think that 2023, well, the big surprise to us was that the economy was stronger than we thought it would be. We expected a strong economy. As I said, we didn't think that there'd be a recession last year, but we thought that overall real economic growth would be weaker in 2023 than it was in 2022. And we did that because we expected interest rates to rise in the first half of the year, as they did. and then plateau in the second half of the year. And we thought that there would be more of an impact, not so much on interest rates, but also on fiscal policy and actual spending in investment plans by corporations and individuals. And what we saw was that the rise of interest rates from 25 basis points to 5.25% rate. We were saying that we didn't think that that would be so sharp of an increase and so large of an increase to such a high level that it would throw the country into a recession. But we thought it would serve as more of a break than it did on actual economic activity. And, the economy did exactly what we said it would do. It would keep growing even in the face of higher interest rates and a dysfunctional fiscal policy. And I think the biggest surprise to us was the amount of growth and strength in the economy. It really, if you look at the real GDP last year, and if you look at the decline in inflation, the rise in interest rates did not have as much of an impact on the real economy as we expected. And so growth was stronger. And I think that was the big surprise to us, was how strong the economy was, not only in the United States, but also in several other economies.
Yeah, if I were looking at things, that was one of the things that struck me, is that the economy remains strong, the jobs numbers remain strong. The American economy and the Canadian economy, to some extent, where I'm from, were a lot more resilient than I gave them credit for. It was, it was definitely, but I start to see, as we're heading out of 2023, I'm starting to see some cracks in that, but we'll discuss that as we now take a step in back into the time machine and come back to present time, and it's January of 2024, and what do we see ahead for us?
Yeah. Okay, it's January 2024. Yeah. So what we're looking for now, one of the points that we've been making to our clients for several months now is that, investment demand for gold and silver are based, whether or not investors want to buy more or less gold and silver is based primarily on investors' attitudes and expectations for the economy, for financial markets, and for politics. And usually economics and financial market conditions have the dominant role there, and politics are sort of a supporting actor. We think in 2024, politics are going to weigh much more heavily on investor attitudes toward the state of the world, and thus investor demand for precious metals, gold and silver, and thus the prices. So we think that politics, and I mean international politics, but also domestic politics, and not just domestic politics in the United States, but United States, Canada. I mean, you have an enormous number of countries that are having elections this year. You also have an even larger number of countries that are facing severe political disunity within the countries. And it's true in Western Europe, it's true in the UK, in the United States, Canada, Latin America, parts of Africa, Russia, parts of Asia. We think that domestic and international politics will really take center stage and cause investors to sharply increase their demand for gold in 2024 and modestly increase their demand for silver. And as a result, we expect gold prices to rise further to new record levels, and we expect silver prices to maintain where they are pretty much right now with some upward bias.
Okay. When you talk about gold prices reaching a new high, will these be sustainable highs, or will it be like last, December, where it went sharply up to 2152, I believe it was, in a blink of an eye, and then back down again? Is it going to be another one of those, or will this be more sustainable?
Well, I wouldn't say that the price was not sustainable in its high last year. the price averaged, the price averaged first off, we project annual prices and we go out 10 years for gold and silver, and we go out to 2050 for platinum group metals. But we also project shorter term prices. And if you look at the gold price last year, it averaged 1804 in 2022, and we thought it would rise sharply to 1862 last year on average, but instead it rose even more sharply to $1,952. So it was $90 higher than we thought it would be. And that's partly because it spiked higher and early in the year, and then it came down, but it didn't come down at quite as far as we thought, or as long as we thought. And then it spiked higher again later in the year, which is what we thought. So looking at 2024, we expect the same kind of behavior, possibly a little bit more virulent. So we're looking for gold prices to average around $2,050 this year. Now, for the gold price to average $2,050, so roughly $100 more than it did last year, for the gold price to average $2,050, you're going to have significant spikes sharply higher. So we wouldn't be surprised to see sharp spikes in the gold price in the first 4 months of the year and in the final 4 months of the year, with something of a lull possible in between. But if you're going to have $2,050 average price, that lull, that second and third quarter lull that is seasonally possible, A, might not occur because of the political environment, and B, wouldn't necessarily see the gold price falling back below $1,900. So we think the gold price is going to stay high, and yeah, there'll be spikes, but we think that you'll see a significant increase in the annual average price of gold over the course of the year, because people are going to be focusing on great uncertainties and concerns that they have about the political environment in their own countries and on a global basis.
Yeah, that's important to note. You when you talk about gold prices, and I always forget that when we have our conversations, you're looking at a longer term average price of the gold, as opposed to me with the attention span of a hummingbird looking at the quick spikes where they happen.
Mm-hmm. Well, one of the interesting things was, if you look at the spike on December 3rd, it's Sunday night spike to a new record price. This price stayed above $2,100 for 20 minutes. And that was very telling to us, because if you look at previous spikes to records in 1980 and then in 2011, they didn't last 20 minutes. They were like 5 minutes, and then the price came down. Prior to 2013, the biggest one-day move in gold prices was to the downside, and it was the day after gold hit $850 in January of 1980. Everybody knows that the gold price hit $850 in January of 1980. They don't know that it fell like 150 some odd dollars the next day, and that the average price that year was like $600 or $616. So it's like trying to pick those peaks. We've done good jobs picking peaks, but that's like trying to catch a falling knife, and also those peaks are far less important to the overall market, because mining companies tend not to sell at the peak and not sell at the trough. They get the quarterly and annual average price. Fabricators tend to get the quarterly and annual average prices, and most investors do too. So it's really those quarterly and annual averages that are important across the market, although people tend to focus on those peaks. So just to stay on the pulpit a little bit longer, over the last 3 years, you keep hearing people who don't really understand markets say, I don't know why gold prices are so low. And you look at the market and you say, I can see that if you're picking a peak and you're saying, oh, the price got over $2,000 briefly in January and now it's $1,880, you might think the gold price is down. But the reality is that the gold price has set consecutive records for like the last 3 or 4 years. It was 1799 was a record annual average price in 2021. $1,804 was a record annual price in 2022. And 1953 was a record price last year. And okay, yeah, it's down from the peaks in each of those years, but these are record prices. And they're record annual prices. And that's what's important in the market for producers, for refiners, for fabricators, and for investors.
Yeah, I agree. It's definitely a sign of a stronger market rather than a volatile market. Some people, before we move on to gold, have suggested that the moves in December, and I know we're looking back short term, but you've kind of alluded to it going forward, that the average price for gold is going to be much higher in 2024. They've suggested that 2000, rather than being the upper limit of these peaks, is now going to be the floor. Is that overly optimistic, or are they kind of right in a sense?
I think that's probably a little bit overly optimistic, and we as we're speaking, the price has gotten down to $2,022. And the scope for gold prices to fall below $2,000 is very great. And I wouldn't be surprised to see it in the first quarter of this year, even, because as you're seeing over the first several trading days of January, the gold market and silver markets are following the stock market and ratcheting down their bullishness because they're realizing that the Fed is not likely to lower interest rates 6% or 5%. And if there is a recession, it may not be as catastrophic as various groups, including CPM Group, had thought a year or two ago that it would be. So I think that thinking that the floor for gold prices is now $2,000 is unrealistic, given the amount of time that the gold price has not been above $2,000.
As I say, I hear what people say, but I go to people like you that have a bigger and a broader view of the marketplace to see if if they're overly optimistic or pessimistic in these types of scenarios. Let's move over to gold's poor cousin, the silver market. You're projecting new average highs for gold. Is it going to pull the silver market with it, or are we looking, at another kind of year of silver just being silver?
I think silver prices will rise, but they're going to rise later than gold. And they'll be more restrained. So our expectation is that the silver price is going to be roughly flat on an annual average basis in 2024 compared to 2025. However, we think what we're looking at is our expectation is the silver price will be relatively flat for the first 3 quarters of this year. And then in the final quarter of 2024, you might start seeing the silver price start to rise. And during that period, it might actually rise faster than gold in percentage terms.
I see. And silver's a bit of a dichotomous metal in that it's part precious metal, it's part industrial metal. Which do you see to being the bigger influence on it in 2024, the industrial side or the investment side?
I think it's the investment side, and you're seeing that the silver price was relatively flat this year or last year in 2023. And part of that reflected investor selling. Investors were net buyers of silver last year, but there was a fair bit of reselling of silver by investors, some of whom were disenchanted because the price wasn't, $500 or $300 or $75. And some of it was, as one investor said, no, some people who invest in silver just needed to sell the silver in order to buy food and gasoline. So I think there was some disenchantment, which is going to spill over this year. So I think that it's investment demand primarily. Now, on the industrial side, there's a whole lot of hoopla about silver use in solar panels. And there are these wildly unrealistic expectations of, silver use in solar panels going from like 130 million ounces in 2022 to 500 million ounces within a couple of years. That's not going to happen. You're seeing strong growth in silver use in solar panels, but it's not nearly that great. And we're working on coming up with numbers for 2023 and 2024, revised numbers. We know that it's higher than we had been projecting, but the solar panel industry is being a little bit more closed-mouthed about how much silver it actually used. You're also seeing increased silver being recycled from end-of-life solar panels, which is something that a lot of people don't want to acknowledge is actually happening. And you're seeing weaker silver use in other applications. I mean, silver use in solar panels has been the big growth story for the last 20 years. And it continues and will continue to be the big growth story in silver use. But people are overlooking the fact that even while solar panel use of silver is rising, silver use in other industrial fabrication applications is not so dynamic. And so if you look at total silver use in fabricated products, it's being held up by solar panels, but there's weakness in other industrial applications. If we're right and we see a recession in 2024, that's going to hurt silver use in other applications, even if solar panels continue to use more silver.
So in talking about silver panels, I have to look at the elephant in the room, Jeff. China has a stranglehold on the solar panel market currently, and the West is trying to break that dominance. If the West starts to make moves in that direction in 2024, will that not increase some of that demand for silver and silver panels?
I think, the issue of competitiveness in solar panel manufacturing will have a minor effect on the growth of silver use in solar panels. And I'll say that it's not just the West. I mean, you have countries around the world that are saying, can we build into the silver panel industry? And it's not just the solar panel industry that matters, but also the industries that make the components and raw materials that go into the solar panels. Yes, China has right now a lot of dominance in that. But I think the real stimuli for growth in silver use in solar panels is going to be from the demand side of the solar energy market, not from the supply side. The supply side and the West saying, let's build capacity, and other countries saying, let's build capacity, that will boost the silver use somewhat. But it really will depend on the demand side. And one of the things that you're seeing is that as you look at what they call the energy transition, solar panels and solar energy are competitive with conventional energy sources and are well financed. Electric vehicles are less competitive than ICE engined vehicles. Wind power is somewhat less competitive, but the use of solar panels to create electricity is there, and it's now, and it's growing, and it's going to continue to grow at a very strong pace because it makes economic sense. It's economic. If you have a new technology that is economically and technologically superior to the existing one, you will pivot toward it. And that's what's happening with solar power. So it's the demand side that's really going to support increased silver use in solar panels in the long run. Now, competitiveness and building excess capacity on the supply side will boost the demand for silver on a shorter term and episodic basis. As people build capacity, they'll start making solar panels. they'll use more silver. Then there'll be a period of time when there's an oversupply because you have new suppliers coming in to an existing market, and then you'll have a pullback. So that is a less important factor in driving silver use in solar panels than the end demand for solar panels, because they make economic and technological sense for users and generators of electricity.
I see. And since we're on the topic of the energy transition, that's probably a big factor in the platinum and the palladium markets, given that they're using the catalytic converters. So you alluded that the electric vehicles aren't necessarily taking off in demand in the same way as the solar panel industry is. What do you see that having as a knock-on effect for the platinum and palladium markets?
Yeah, electric vehicles are growing in terms of their total market and in terms of their market share of light duty vehicles. And I don't want to belittle that, but the market penetration rate and the growth in the electric vehicle market, both on terms of supply and demand of electric vehicles, has been a lot slower than a lot of people thought. And it's running into increased headwinds. That said, it is growing and it is increasing, albeit at a much slower rate than some people had expected and some people expect, or had expected and had hoped for. So, but in terms of the overall light duty vehicle market, electric vehicles are growing. That is having an effect of reducing demand for platinum, palladium, and rhodium for use in auto catalysts, because the electric vehicles don't use them. Hybrid vehicles still use them, and in fact use a little bit more PGMs than regular vehicles because of the cold start and stop pattern of engines in hybrid vehicles. But one of the factors that caused platinum, palladium, and rhodium especially, prices to fall more sharply in 2023 than we had expected was the reduced demand for PGMs in autos. And we've just completed our long-term platinum, palladium, rhodium outlook report, which, supply, demand, and price under different scenarios going out to 2050. And our basic view is, over the last 50 years, from 1973, when the first models of automobiles that had catalytic converters were put on the road for model year 74 in the United States, from 1973 to 2023, for half a century, the story for platinum, palladium, and rhodium was the growth of auto catalyst demand and the need to supply the auto market of those three metals. The next 50 years are going to be primarily characterized by the reduction of demand for platinum, palladium, and rhodium in the auto catalyst market because of the shrinking of the total market for internal combustion engine vehicles. And right now it's electric vehicles. There may be other technologies that emerge over the next 25, 50 years. But, it looks as if petroleum powered vehicles, they're not going away anytime soon. And we still have half of the vehicles that we think will be being made in 2050 being petroleum fueled. We have, as does the International Energy Agency, we have petroleum being the major source of energy in 2050 for humankind. So the use of PGMs in catalysts to clean the exhaust, both of automobiles, motive power, and stationary power, is not going to go away, but it is going to contract as the energy transition does move forward, however slowly it moves forward. And that is probably going to be the overriding characteristic defining platinum, palladium, and rhodium markets for the next 50 years.
Based on your observations, do governments back away from their commitment to electric vehicles by 2030?
I don't know that they'll back away from it. I think they'll keep it. It's still the best available alternative technology. We have been looking at hydrogen engines. So is Toyota and several other companies. And it's quite possible that that technology by 2030 will be starting to emerge as an alternative to both internal combustion engines that burn petroleum products and electric vehicles. I think you have several things that are going to happen. One is, a lot of people don't understand that electric vehicles are a long-term solution. In the near term, all you're doing with electric vehicles is you're moving where the combustion occurs from the vehicle to where the power is generated. The electricity is generated to power those things. So electric vehicles have the risk of hitting a lot of consumer disenchantment as people realize that buying an electric vehicle and living with the consequences of using an electric vehicle doesn't necessarily have as large of an impact on the emission of carbon dioxide as they think it does. You're not solving global warming by moving to electric vehicles now. It's a longer term solution because once you have vehicles being electrified, and then you can shift the source of that electricity away from coal and bunker oil and natural gas to solar power, wind power, water, hydroelectric power, nuclear power. Once you've made that move, then you can start doing that and reduce the carbon dioxide emissions. But that's a long-term reduction in carbon dioxide. It's going to do very little to meet any COP28 or Paris Accord agreements. And we're not going to get to net zero emissions by 2050. It's quite clear.
Yeah, I've been saying that for quite some time, that we can't get from A to B with the current technologies. So it's, we need some innovation to come up. So smarter people than you and I will come up with that, I'm sure. But let's take a look at the bigger picture. We've talked a little bit about Fed policy. You see 3 interest rate cuts towards the latter part of the year. You've alluded to recession is coming, but you've also alluded that it isn't necessarily to be as harsh. So are you projecting a more of a soft landing that the Fed is praying for?
No, and first off, let me clarify. I mean, I wouldn't be surprised to see the first interest rate cut come as early as March or May. But I do think it's not going to happen in the first couple months of this year. So, people have to cool their jets a little bit in expecting. The other thing is, there's a lot of people who are hoping for lower interest rates. Interest rates will fall only when there are significant signs of much greater economic weakening that clearly emerge. The Fed is not going to lower interest rates unless it sees signs of significant economic problems and weaker demand. So, be careful what you wish for, because lower interest rates will only accompany a sharp weakening in overall economic activity. Now, we think that will occur. We think there will be a recession. I don't necessarily believe in soft landings. I think what you can do is postpone the emergence of a recession, and you can ameliorate the extent to which a recession is deep or long through interest rate policy. But I don't know that we can avoid it. And again, it's, I mentioned this in passing earlier, fiscal policy and the actual investment and consumption trends of corporations and individual consumers are much more important in determining recession or economic growth than is monetary policy. The monetary policy is more in a response to fiscal policy or fiscal bad policies and actual real economic activity. And I think that people, politicians love it when investors and consumers focus their ire on monetary policy and the Fed, because what they're doing is deflecting the blame from where it belongs, which is dysfunctional fiscal policy, to monetary policy, which is sort of held hostage because the Fed has to do what it has to do to allow the economy to accommodate the dysfunctional fiscal policy. And it's fiscal policy that really needs to be fixed. And the monetary policy can only stanch the bleeding. So I think that all of that factors in there. I don't think that we avoid a recession. We can postpone one. We can ameliorate how deep and how long it lasts, but I don't think that you can say we've banished recessions from the economic cycle.
No, that's fair. When I look at the economic data, there's three things that I have standing out to me, and a couple of them are cross-purpose to each other. And as a result, I wonder aloud whether or not the Fed can actually reduce interest rates or not. The two items that I see that says that the economy is still strong is the jobs numbers and the wage rates. The wage rates and the jobs numbers continue to remain strong, and those are signs of a strong economy. Yet on the flip side of that, if you look at the Christmas selling season, when adjusted for inflation, it was a pretty dismal year for retailers. So the consumer seems to be extracting themselves out of that, economic equation to some degree. Do you see the Fed moving towards reduction before jobs numbers start to decline, or is this going to be a reaction to declining jobs numbers?
I think that the Fed will be reactive. That's what they do. And as I said, if you have good jobs numbers and inflation remains on a downward trend, the Fed has no incentive to lower interest rates. And you have to remember 5.25%, 5.5% interest rates are sort of the low end of the level that you saw for Fed funds rates from the late 1960s until 2008. So even though rates have risen 5% over the last 2 years, year and a half, they're still low by historical standards. They're not so high as to turn off investment and consumption. To answer your question shortly, the Fed's going to be reactive. The Fed's not going to say, oh, everything's hunky-dory, so we can lower interest rates. The Fed's going to say, we will lower interest rates when it looks like we have to.
Yeah, well, that's fair. The Fed is reactive. So as we continue to look at 2024, there's always going to be surprises. And I guess by that nature, surprises really aren't predictable. But if you were going to look at particular areas where surprises may come, where might those areas be?
I think, again, we're looking at the political realm as being a bigger area. Obviously, they're going to be economic and financial issues. One of the things that we've pointed out is what we're calling the unforeseen consequences of financial market regulations. There's a lot of regulations coming into play in the UK, in the European Union, in the United States, and Canada, and in other countries. And some of those regulations could have the unforeseen consequences of really putting spanners in the works of the financial markets. And you could see, and we're seeing this already, with banks and with brokerage houses. You could see that financial markets may become less efficient, and there may be an increase in problems and a decrease in market liquidity as a result of these regulations. In the commodities markets, for example, you have seen already a reduction in the offering of financial services in commodities to investors and to mining companies and to other companies that use commodities or produce commodities. The brokerage houses are saying the increased regulations are too expensive and too cumbersome and have unforeseen risks to us. So we're getting out of this market. And, our clients that are involved in commodities markets are having trouble. They have to find new brokers because the companies that have been providing commodity brokerage services are pulling back from doing that. And you're not only seeing that in commodities, you're seeing it in equity markets, you're seeing it in bond markets, you're seeing it in banking, commercial banking, consumer banking. And these unforeseen constraints on financial markets could be a major factor in contributing to the onset of a recession. So I think that's one of the the things that could surprise everybody is a contraction of financial needs. Obviously, ongoing problems between the United States and China and the rest of the world, that could be a problem. We don't expect China to invade Taiwan. We expect tensions to continue to be difficult between between China and the United States and the rest of the world, especially its East Asian neighbors. But that could go wrong. And, when you have increased tensions, the potential for things tipping over into a really more problematic level are definitely there. U.S. domestic politics clearly have to take a high level. EU politics, I think, also have to take a high level. And then there's the fact that you do have wars and problems and civil wars in various parts of the world, any one or more of which can become more problematic. I think October 7th was definitely a surprise to the Israeli Defense Forces and Mossad, but everybody saw that as a problem that was growing. And, its eruption and the way it erupted and the timing were the surprise. And you can go around the world and you can pick out hotspots that are problematic. And then, as I said earlier, you have 60% of world GDP coming from countries that are having elections this year. And a lot of those elections are going to be very disruptive. You're already seeing that. You'll see it in the United States for sure. The Republicans have promised that any race they lose will be challenged as being a flawed election. But you're also seeing that in Indonesia already and in various other Asian countries. And you're going to continue to see it really around the world. So I think that those kinds of problems are also out there. We don't really understand where they will pop up, but they probably will pop up.
Yeah, interesting times indeed. It's the old Chinese curse, isn't it?
Yeah, I don't know that it actually was, but everybody thinks it was. Yeah.
Yeah, that's true. It's a good way to think of it at any rate. Jeffrey, it is always a pleasure to chat with you. It was good to review what was said for last year and get an outlook for 2024. And as the year progresses, I look forward to having you back on as we deal with the rolling environment that we're going to be facing.
Okay, well, thank you for calling and having this discussion. I appreciate it, and we'll be around later this year. So
not a problem. If people want to follow the works that you do, how would they do so?
Our website is www.cpmgroup.com. There are free reads and free videos and free reports there, as well as information about buying our yearbooks and buying other services, research and consulting services that we do, as well as information about the other markets like manganese and molybdenum and tantalum and niobium and base metals that we follow, and our investment advisory services and our commodity advisory hedging services and things like that. And then you can always send an email to info@cpmgroup.com and say, I'd like to talk to you about ways you can help me.
Perfect. I advise anybody to take Jeff up on those offers. Those yearbooks are invaluable for information. So until next time, thanks, Jeff.
Thank you, Michael.
The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.